Hi, everyone. Welcome to our webinar this morning. What should you be tracking? My name is Allison Forche, and I'm a relationship manager here at Gerber. And we are delighted to have you join us to hear Melanie Britton share with us today. A little bit about Gerber. We help growth-minded entrepreneurs build kick-ass businesses and live happier lives. Our successful clients are industry leaders who have happy, fulfilling lives and make money while doing it. Triple E is our forum-based program that provides processes, strategies, and sequencing for success. Annual revenue is 200,000 to 3 million, and we are taking this program 100% online on demand in September. So you'll have the opportunity to choose how you participate in the program moving forward, whether that's in person or online. And then Gerber Clarity takes it a step further by helping you understand what your business can do personally and tying in personal and financial goals and dreams so that once again, you as an entrepreneur can live a happier life. We are delighted to have Melanie Britton with us today. Melanie holds a BBA in finance from Ohio University. She is a consultant specializing in finance and operations who partners with business owners, CEOs, and executives to tackle their biggest challenges. After spending nearly 20 years working in financial planning and analysis, strategy, and operations, Melanie knows how to assess key performance indicators and advise her clients so their businesses can reach peak profitability. Melanie creates customized recommendations for each client with their short-term and long-term goals in mind. So without further ado, let's welcome Melanie.
Thank you. I'm going to go ahead and share my screen with everyone so you can see the presentation. All right. Well, thank you all for joining today. Originally, when we discussed putting this session on key performance indicators together, we thought about doing it as more of a workshop in person situation so we could really talk more about your businesses and get down to specifics of what KPIs would help your business. Obviously, with the current state of the world, that wasn't going to be feasible. So I did my best to put together a variety of information, hoping that everyone learns something today. We will go through some basic definitions, look at how to calculate some KPIs, and then we're going to pretend to set goals that make sense with an annual financial plan. So our discussion topics today, we'll go a little bit over my background just so you know who is spewing this information at you today. And then we'll talk about what is a KPI, how to create KPIs, determining which KPIs to track, common KPIs for the industry with some calculations, how KPIs relate to the annual budget, how to set KPI goals, and the cadence for tracking KPIs. So a little about me. I started off my career working at Navigant Consulting and litigation consulting. I specifically worked on business interruption cases. I'm sure all of you guys, if you have a business interruption policy, you've become a little bit familiar with that this year, seeing if it covers losses from a pandemic, and have been severely disappointed that it actually really doesn't cover much of what you need. So a few of examples of the type of projects and clients I worked with were hotels and resorts that were badly damaged by hurricanes, businesses impacted by the terrorist attacks of 9/11, and companies that suffered from environmental disasters like oil spills, coal mine collapses, things like that. From there, I decided to go over to the Chicago Tribune and work in a specialized financial strategy group. I was part of a team that really worked on any new products that the company was thinking about launching, tested the financial viability of those products, revenue forecasting, created new pricing structures for the advertising department, and built their management reporting suite. While I was at the Chicago Tribune, I really found a passion for advertising, marketing, things of that nature. So I decided to go work at multiple advertising agencies over the years and did a lot of the same work: annual planning, management reporting, revenue forecasting, worked on the operations side, implementing new accounting systems and project management systems, and then just any ad hoc analysis. And then about 5 years ago, I decided to go off on my own. I found I really had a passion for building partnerships and the educational aspect of my work. So I thought that this would be a good fit so I could partner with many different business owners and just help them tackle their problems. So I work on all sorts of special projects, finance and operations related. All right, what is a key performance indicator? A KPI is a type of measurement that helps you determine how your organization is performing. KPIs are a critical part of managing your plan on an ongoing basis. While not all KPIs are directly related to your annual financial budget, they're all factors in your short and long-term company goals. So an example of something that wouldn't be directly related to your financial budget would be if you wanted to improve customer satisfaction. So that customer satisfaction score wouldn't be in your annual financial budget, but indirectly, it can be one of your shorter or long-term goals that's something you want to improve. And then indirectly, it would affect, hopefully, a boost of sales if more customers are satisfied. And KPIs can be at the company level or more targeted to a specific area of the business. So you can say you want to grow sales by 5%, or you can say you want to grow liquor sales by 10%. So it can be just at the top level or something more specific. Every key performance indicator has to have a measure. So this sounds obvious, but there must be a clear expression of what you want to measure. You can't just say, I want to have better service. You have to have a way to measure that, like a customer satisfaction score. Every KPI must have a target that matches your measure and time period of your goal. So if your measure is a percentage, your target must be a percentage. Every KPI must have clearly defined data so that you're always comparing apples to apples. So when you're tracking your data, you always have to be tracking it the same way. And then there needs to be a reporting frequency. So each KPI can have different reporting needs: weekly, monthly, quarterly, and we'll get into this a little bit more later. There's obviously preferences for when you update your KPIs, but sometimes you can't based on when the data becomes actual, or actually time constraints can factor into that too. So when you're designing key performance indicators, there's some questions to keep in mind. The first one is, are the KPIs derived from a valid strategy? So you can say that you want to add 10 new customers per week. And then I'm going to ask you why. Is it just because you want to add 10 new customers a week, or is there some reasoning behind it? And so hopefully your answer would be, I want to add 10 new customers per week because I know the average new customer brings an X amount of sales. And then this would, multiplying that out together, would tie into your revenue growth goal. So are they simple to understand? So could everyone at your business understand what the KPI means and at least some semblance of what data points go into calculating it? Are they relevant, not just now, but over time as well? So are they something that's helping you reach your long-term goals? Are they clearly defined? Do they focus on improvement? And do they offer quick feedback? So there are some challenges when you are coming up with your key performance indicators. So the first thing is you must have a clear business strategy. So you have to know what you're trying to do with your business long term in order to know what you need to be tracking in order to get to those long-term goals. So if there isn't a business strategy, it's hard to understand what you should be looking at. Accuracy, measuring, and reporting. So do you have the proper systems or tools necessary to input the data so you can calculate the KPIs? And then buy-in. So it's important for your staff to understand the reason behind each KPI to facilitate achieving that goal. So determining which KPIs to track. So when I approach this, the first thing I do is I'm going to do a deep dive into the financials to see where you stand. So it's really important that you understand your P&L, try to identify areas that require attention. If finance numbers aren't your thing, ask a friend or somebody who has that type of background to walk you through it. It's really simple once you get the hang of it, and then you can learn and you can start doing it yourself. So you need to determine the long-term goals for your business. So write down the long-term goals. What are they? Do you hope to expand? Do you hope to sell? What are you looking to do in the next 5 years or so? And once you understand where you want to go, you can start focusing on the financial components you need to get there. And then next, I would create my short-term goals off my long-term goals. So the short-term goals will be your first steps to achieving your long-term goals, and that's how you can decide which KPIs to start tracking for that next year. And you need to figure out what can be calculated now. So what good data do you have now that you can start calculating your KPIs? So you're going to see things in your business that needs improvement, but you don't necessarily have a year's worth of data to be looking at where you stand. So that goes into the next bullet point is, if you did start tracking that data, what could you start tracking in the future? So start thinking through data that you could start recording so that 6 months from now, you have a data set to start looking at those KPIs. And then I always recommend to just keep it simple, focus on 5 to 7 metrics. You could seriously sit there and calculate ratios of this and that and the next thing, but you just need to find 5 to 7 meaningful, actionable metrics to be updating and calculating frequently. So we're going to walk through some common KPIs for your industry, and we'll do a few calculations as well. So keep in mind, some of these calculations might vary slightly for your particular type of business, but this should give you a pretty good idea as to the approach. Some of these KPIs are super obvious, as you'll see in the beginning, and then some of them are a little more complicated. Since we don't know each other, I don't know what level of data you have or what you've been tracking, so I just try to give a broad overview. So hopefully everybody can take something away from this. And then you'll also see as we go, I've laid out some of the data in charts, and that is definitely not something that's necessary to do, but I find that visual learners sometimes respond better to seeing it plotted out that way. So I just wanted to include a few examples of that. So if that's how you learn better, then just a way to think through as you start doing your own KPIs in the future. So the first key performance indicator is obviously sales. I'm sure everybody has a close beat on that, but there are some different ways that you can look at sales. So like we talked about earlier, when you're setting your sales goal, it can be just overall for the business, or it can be an individual business segment. Sales is going to be the biggest driver when you're calculating your annual financial budget, and we'll get into that a little bit more later too. And I always recommend calculating the sales goal by month to account for seasonality. You can do it by week too, but when you do your financial budget, you will come up with an annual goal and kind of break it down by month, but the smaller time period you can do it is the better. Just a very simple breakout for tracking if you're tracking by month. So you have your actuals on the top line, your goal on the bottom line, and your variance, I'm sorry, on the middle line, and your variance on the bottom line. And then keep a running full year to date to the right so you can see how you're tracking. So this person's tracking $4,000 under their goal right now. And then again, if you're one of those visual learners, it's nice to kind of plot it out on a chart so you can just kind of see how you're trending and see where you need to be going for the rest of the year with your goal. So the next one is historical sales. So historical sales will show the company performance over time. It's best to track this KPI by day, by week, by month, and by year. I understand not everyone has the resources to be doing that, but as many data points as you can have looking at that so you can see variances is very helpful. Historical data reports will help you identify trends, and long-term historical sales data will be crucial information for revenue forecasting. So when you're forecasting out your revenue, you will know that you always do your most business in this month. And so we need to be accounting for that when we do our revenue forecast, or the month of August is always super slow. So just things that you can see when you look at your historical trends. Another thing to think about when you're looking at historical sales is to only use the years that are applicable to your current business model. So if 5 years ago you had a really small space and you didn't have the capacity to do the type of sales that you can do in your current space, it's not really relevant to be plotting that data from 5 years ago with your current data. So think through things like that when you're looking at historical sales. All right, now on the expense side, so cost of goods. Cost of goods are most likely your largest expense. Because the expense is so large, it is important to monitor on a weekly basis, again, if possible. You can't manage the budget if you aren't tracking the data. So if such a large expense starts getting out of control and you're not, excuse me, and you're not tracking it, you're going to start exceeding your budget very quickly without realizing it. Finding small ways to decrease the cost of goods sold will have a large impact on your bottom line. And many other KPIs depend on having a solid understanding of the cost of goods sold. So you'll see that as we keep going through this, that it's an important calculation for calculating some other KPIs. Just a simple calculation. You have your beginning inventory, your purchase inventory, and your final inventory. So it's beginning inventory plus purchased inventory minus final inventory gives you your cost of goods sold. The next important one is your food cost percentage. So once you know your cost of goods sold, it's a pretty simple calculation. The food cost percentage will show you the difference between what the business is spending on food and what the customer is spending. And then you can also use this calculation for beverages. So you can have one for food cost and one for beverage cost. So same calculation at the top for the cost of goods sold. So you have beginning inventory plus purchase inventory minus final inventory gives you your cost of goods sold. And then you're going to divide that into your sales for that time period. And you'll see your food cost is 30% of sales. So another important KPI is the prime cost. The prime cost uses the two largest expenses typically to calculate how much it costs to operate your business. So two largest costs typically are cost of goods sold and your total labor. So just like improving the cost of goods sold, improving the prime cost will directly impact the overall profitability. And if possible, the prime cost should be a weekly calculation, again, if you have the data and time permitting. So you simply add your cost of goods sold and your labor cost, and that gives you your prime cost. And then again, just wanted to show another example if you're one of those visual learners, if it helps you to see it visualized like this. So prime cost as a percentage of sales. Once you know the prime cost, calculating the prime cost as a percentage of sales would be the next step. Prime cost as a percentage of sales will be the more actionable metric. Ideally, the prime cost will go up as sales go up and vice versa. If you find that that's not the case, that's when you need to do a deeper dive, take some action. So if you were looking at this weekly, it's easier to identify the problem versus waiting, for a month or a quarter. So, if you updated it for the last week and you see that things seem out of whack where the prime cost and sales didn't go up or down in tandem, that's when you can think, oh yeah, there was this, I don't know, huge snowstorm last week unexpectedly, but we were staffed and had inventory for normal sales. But obviously sales weren't as high because it's a big snowstorm. So there's no problem there. It's just one of those fluke things that happens. No need to dig in further. So it's just easier if you keep this up to date. So looking at the prime cost as a percentage of sales calculation. So first you'll calculate your prime cost again. So the cost of goods sold plus the labor cost gives you your prime cost. And then you divide that into your sales to get your prime cost as a percentage of sales. And again, it's laid out by week so you can clearly see. And again, for the visual people, laid out as a chart so you can see kind of how they go up and down in tandem. So if I was laying this out on a chart and looking at it and I'm like, okay, something weird looks like it's going on weeks 8, 9, and 10. So that's where, you can go in and dig in and see if you can figure out what happens. So another important KPI is employee turnover. Obviously, turnover is a normal part of the business, but it's also very costly and very disruptive, I'm sure, as everybody knows. So keeping an eye on turnover trends will help you identify the signs of a potential problem and help you get ahead of the situation. So in order to calculate that, you just need to know how many employees left in a month and then the average number of employees you had during the month. The average can get a little funny because you can have, a couple people starting, a couple people leaving, depending on when they started in the month or when they left in the month. So just do your best to get an average. It doesn't have to be perfect, but you'll be able to start identifying trends. There's also a calculation you can do to see how much turnover costs your business, where you're looking at your training and recruiting budgets. If you're calculating server mistakes for new servers. So we're not going to get into that today because it's so different based on everybody's specific business, but I just wanted to throw it out there that there is a way to kind of get an average calculation of what your turnover is costing you each time somebody leaves. All right, the next one, revenue per available seat hour, or RevPASH. RevPASH stands for revenue per available seat hour. The calculation will use a specific time period, so day, hour, etc. This metric will provide a better picture than average revenue per table since it's breaking it down to a more specific time period. And it's a meaningful way, once you figure out this calculation, to optimize labor scheduling. And I recommend using several time periods to give you the best picture of how to use this calculation. It'll show you the most information if you calculate it several different ways. So a few examples. So this would be the calculation if you just did it strictly by day. So you have your sales, your available seats, the hours that you were open for each specific day. And then you can calculate your RevPASH. So you take your sales and you divide it by your seats time your hours. So it would be, if you look at Monday, it would be $10,000 in sales, and we're going to divide that by 400. So the 50 times the 8, and 10,000 divided by 400 gives you the 25 RevPASH. So we're going to break it down a little further since I just recommended that you do that. So now we're just going to look at our dinner shift for each day of the week. Same exact calculation, but obviously you would have different numbers. Your sales numbers would be different. Your hours would be different unless you're just open for dinner. But same calculation again. So you take your sales divided by the seats multiplied by the hours. So for Monday, you have your 5,000 divided by 50 times 4, and you get 25. And then we're going to break it down one more time, and we're going to look specifically at Saturday night dinner by hour. And you can see there, it gives you a really good picture. If you look over to the right of the RevPASH, you can see very clearly your busiest times, and it would really help with staffing and some of the strategy of how to run during that shift. So now we're going to take a look at how all this information ties together with your annual financial plan. So we're going to think through just on a very high level how you would set some goals. Just want to show you how it can require some trial and error, and just how much you have to consider when you're thinking through setting up your annual budget, setting the goals, how one variable affects another variable, et cetera. So I just put together some kind of fake data for us to look through. So this would be, we're going to pretend like this is a worksheet that we started to start thinking about our 2021 projections. So on the left, you have your 2020 actual data. And then on the right is where we're going to start laying stuff out based on our initial thoughts. So we feel like sales will be going up next year because we've been on an upward trajectory. We've acquired a lot of new customers recently. So we feel like we can increase revenue from 1 million to 1.15 million. That feels pretty comfortable to us. And then the other thing, we want to see if we can get that prime cost of sales percentage down a little bit in order to improve our net income. We know that our cost of goods sold will probably stay about the same ratio to revenue. So what else can we improve to improve that prime cost as a percentage of sales, which would be our labor cost? And we are kind of feeling like we had kind of high turnover last year. So maybe one way to improve the labor cost would be to help get the turnover down next year. So the first two columns are the same as what we just looked at, but now we added a third column where we're going to try to improve our turnover to help get that prime cost as a percentage of sales down. So we've done that calculation I talked about that we aren't doing in this presentation to figure out how much our turnover costs us. And we found out for every percentage of turnover, it costs about $2,000. And you can see that kind of down towards the middle bottom of the slide. So We think that we can get our turnover rate down from 20% to 10%, and therefore we would have a $20,000 labor credit because we're going to have less turnover. So we're going to keep our revenue that we were thinking through, that 1.15, and we're going to keep our cost of goods sold at the same ratio, but we're going to give ourselves a $20,000 credit on labor because we're going to work really hard to have less turnover. And that will take your prime cost down. And so as you can see, your prime cost as a percentage of sales will now be 63% instead of 65%. And that all seems very reasonable. So if you look at the very bottom, then you can see that you now have improved your net income from the 20% in 2020 to the first projection of 22%. And then by getting that $20,000 credit from turnover, you've improved it to 24%. So this is a very high level kind of silly example, but I just wanted to show you how changing one metric or one variable changes another variable, and you just have to think through what seems reasonable, what happens if you change this, how does that change something else, and just wanted you to kind of get into the thought process a little bit. So again, goal setting takes some trial and error to make all the puzzle pieces fit, as you kind of just saw. It's important to look at the full picture of the business when setting goals. So like I said, each variable affects another. So if you raise this, it does something to this other variable. And is that other variable now still feasible to what you know about your business? Always use historical data as a feasibility test. So you know, if you're looking back at your average of your last 3 years of your prime costs and you've decided you want to, you know, decrease it by 20%, I mean, is that feasible? How are you doing that based on your historical data? Then always set goals that are realistic, but also require some challenge. So it does no good to say, you know, I'm growing revenue by 25% this year. Like, how are we doing that? And then if you just go ahead and build your budget out that way, then none of the other expenses in your business are going to make sense if you're basing it off of a 25% revenue growth, if that is not feasible. If it is feasible, great, congratulations. But if it isn't, your whole budget, it's not going to be usable if you're basing it off of something that's not reality. And then just a little recap about the cadence for tracking KPIs. So I guess the couple things to think about is, one is the new data available. So some data you may have daily, some weekly, some monthly. So my recommendation is always to update as soon as possible, or as soon as possible that makes sense. And you know, weekly, monthly is as most important if you can do it, but you have to do what works for you, and you have to do what works for what you have available as far as your systems go, or however you track your information. And then the other thing to consider is, if you don't have a dedicated person on staff to update the data, you know, if you don't have a bookkeeper or a controller or whomever would typically do that, and obviously you're super busy running your business, that's something to factor into. Like, this shouldn't be something where you're staying up till midnight to make sure you get this updated weekly if bi-weekly works better with your schedule. So just some things to think through. There's no, you always have to do what's best for you, update as frequently as you can, but it's not like if you didn't calculate your turnover percentage for 3 months that it's going to like severely impact your business. You just have to do the best you can and go from there. Now I will open it up to any questions anybody has. I know when you're talking about financial data, I know some of it's private and personal too. So if you don't feel comfortable asking a question right now, please feel free to reach out to me at any time. I'm happy to talk through anything, any questions you have, or if, I don't, 2 weeks from now, you think back to this and you're like, what was she talking about here? Please reach out. I'm happy to jump on the phone, chat through anything with you at any point too.
Melanie,
Oh, sorry, go ahead.
yeah, Melanie, this is Jeff Tubal. I'm a CPA tax accountant at BDO, and I'm just listening. I like to listen in on Gerber's events. And I was just curious how you're advising folks to look at these KPIs and budgets, et cetera, factoring in the COVID shutdowns, and like how does that aspect factor in, and what are maybe your top 2 or 3 recommendations when they're looking at all the things you talked about and factoring that in when doing comparisons and budgeting?
Yeah, so very good question. I wish that we were doing this under different circumstances, where we're focusing on some of the things I talked about or would be your top priority, not COVID. Right now, honestly, I would be advising my clients to, in the restaurant bar industry, to probably not be worried about most of what I just talked about and to be focused on their cash flow. I mean, I'm just being totally honest. It's just, it's important to like keep tracking these things, see where you are, but I know things are just absolutely terrible right now, and keeping the lights on and making sure you have cash flow will probably be most important.
Hi, Melanie. This is Aaron Cornell. Thanks so much. This is an amazing presentation. I was wondering if you had any suggestions for newer businesses or business owners who have purchased restaurants, that have existing cash flow, but they're looking at the KPIs historical, or maybe don't have, as a startup, don't have as much of that KPI. Are there any nuances you suggest considering there?
Yeah, so if I guess if you're a new business, I mean, I would pick, again, it's so much of this is so specific to your particular business, but I would probably pick just a couple KPIs to start based on our initial conversation, and we would set goals based on some industry standards. And then, because you don't have historical data to go off of, and so much of this is based on your historical data. So we would probably just use some industry averages to get started. And then as you were in business longer, we can update that then to use your historical information. But you need a starting point, and without being in business for several years, it's hard to find that starting point unless you're just using some averages.
Thank you.
Sure.
Melanie,
Yeah.
how about your planning for your KPIs for the next year? When should you start that process of planning, setting goals, budgeting? How far into the current year for the next year?
Yeah, so a lot of it depends on the owner's preference. Some people just really want to get going in the fall and have this plan ready to go January 1, which is totally fine. Some people prefer to kind of have a rolling plan. So we're just constantly forecasting 6, 12, 16 months out. So then there wouldn't necessarily be a certain time of year you would do it. It would be constantly in motion. And then other people kind of like to wait until February or March and just kind of see how the year is progressing compared to their prior year, so that they feel like they have a little more confidence in how they're projecting. So it really varies based on kind of the owner's comfort. Again, this conversation would be very different if we were in the middle of a pandemic. I understand we have no idea what January is going to be like right now. So planning is a little more difficult. So I would personally recommend people just kind of looking 90 days in advance right now and not trying to do some like full year plan for 2021. We could still be doing what we're doing right now, or we could, who knows, I'll have a vaccine by next week and be cured and out eating out again, I hope. So we just don't have enough information at this point.
Melanie, how do you realistically set expectations for these KPIs on new locations? Because again, if you've had locations for years, your process could be going really well, costs are under control. Then you open that new location and, things get kind of all thrown up in a bit of a mess usually right from the start, and then they kind of calm down. But how do you realistically approach that?
So by nature, I don't know if this is just me, but by nature, I feel like people who work in this type of business, we're a little bit more on the negative side in general. So what I'm normally doing is the business owner normally has these like extremely, in my opinion, unrealistic expectations for that new location. So a lot of it's just going to be some back and forth conversations about, we would look at the existing locations to get an idea, and that would help, I think, more on the cost side than the sales side. But then I'm really going to tamp down expectations a lot. So if the business owner thinks that they're going to be doing, $10,000 a week in sales, we're going to really sit and have an honest conversation about that, and go through, especially if you've opened other locations before, we're going to say, let's go back down memory lane and talk about your first 6 months of when you opened up your last location. So again, when I am having these conversations, I am certainly never like, oh yeah, that sounds awesome, everything's going to be perfect. I am definitely more like, okay, let's think about worst case scenario on everything, and let's factor that into when we're calculating these goals. So a little bit of a Debbie Downer here, I guess, but I think that that's kind of my role, is to be realistic and not think everything's going to go smoothly.
Anybody else with questions? Well, as Melanie indicated, please feel free to take down her information from the slide and reach out to her after this for any more sensitive questions that you would like to address related to today's information. And Melanie, are you going to share the slides with me to send to everyone?
I am, yes. I owe you Monday's slides as well, so I'll get those to you guys this afternoon. And then, you can feel free to share them with everybody. And please do not hesitate to reach out if anybody has any questions, whether it be this week or 3 months from now or 6 months from now. Feel free to reach out, and I really wish you guys all a lot of success. I can't even imagine the stress of what everyone is going through in this industry right now. And I really hope things turn around quickly for you guys.
Well, a big thank you to Melanie for being with us this morning and sharing this information. And we thank you for joining us. And I hope everyone has a great rest of your day.